Now we're continuing our discussion here on leverage. And you'll recall from the previous videos now, there are two kinds of leverage. We have operating leverage, which is brought on by the use of additional fixed cost. And we have financial leverage, which is brought about through the use of additional debt. Now, these types of leverage now, any type of leverage, impacts the income statement. Now, as you see on the board here, I've put up an income statement. You remember we have sales minus total variable cost minus fixed cost. That gives us earnings before interest and taxes, or operating profit. Subtract out your interest expense, you're left with earnings before taxes. Subtract out your taxes, you're left with net income. Two things you do with income: pay dividends or retain it in the firm. And the first dividend you have to pay is the preferred dividends. Take net income minus preferred dividends, you're left with earnings available to the shareholder. If you take earnings available to the shareholder and divide it by the number of shares outstanding, you end up with something called earnings per share. Now, this is the earnings stream, if you will, that's impacted by leverage. Operating leverage is often called first stage leverage. It impacts the income statement first. And you can see the fixed cost right here. This is where the impact of operating leverage is felt. It's felt between revenue or sales and operating profit. And in a video coming up here, we're going to learn how to calculate something called the degree of operating leverage, which tells us the impact that this type of leverage is going to have on our operating profit. The next type of leverage now is financial leverage. It's often called second stage leverage. It impacts the income statement second. In other words, it impacts the income statement after operating leverage. And financial leverage now is really brought about by two things. One is debt. Interest expense is what we measure the cost of debt as. So the more debt you have, the more interest expense you have, the greater the financial leverage. The other source of financial leverage is preferred stock. And we measure the impact of preferred stock on financial leverage through the preferred dividends that the company pays. The more preferred stock financing, the more preferred dividends. Preferred stock is viewed as pseudo-debt. It's kind of like debt. Just like we have interest on debt that we have to pay, we also have dividends on preferred stock that we have to pay. And so debt financing, preferred stock financing, those are two different sources of financial leverage. And you can see it impacts the income statement second, and it tells us the change in our earnings per share given the change in operating profit. And that's measured through what's called the degree of financial leverage, which again we'll talk about in a video coming up here. Put together now, we have what we call the degree of combined leverage. Now, combined leverage takes into effect both the impact of operating leverage and financial leverage. It is the impact of greater interest expense, the impact of greater fixed cost, and the impact of our preferred dividends, increasing preferred dividends. Now, preferred dividends and interest expense, both kind of the result of financial leverage. One, though, is before taxes, and one is after taxes. In some videos that are coming up now, they're going to be formulas that I show you and explain to you, and you're going to see a piece of the formulas now that has preferred dividends in it. And you're going to see the little formula now that we use. It's going to have this item in it right here. Preferred dividends divided by 1 minus the tax rate. Now, preferred dividends divided by 1 minus the tax rate tells us the pre-tax dollars we need to pay the dividends on our preferred stock. The logic being, if we owe $1,000 in preferred dividends, we can't just have $1,000 in taxable income, because the tax man is going to take a piece of it and we won't have enough money left. So when we take our preferred dividends divided by 1 minus the tax rate, we get the pre-tax dollars we need to pay the dividends on our preferred stock. That also puts the cost of preferred stock financing, the preferred dividends, on the same before-tax footing as interest expense. So we're adjusting preferred dividends because preferred dividends is paid after taxes. And we're adjusting it so that we can compare its cost to the cost of the debt financing, which is the other source of financial leverage. So again, as we go forward here, there are going to be a number of videos that we go through to put all these pieces together. There should be some notes on the Blackboard site for you to follow along, which kind of shows you everything. And but we have some more videos to come here with the leverage topic, and we'll get to that right now.